Want to bring in Ben Willis here at Post 9, talk about what this means, not just for today, but long term. Good to have you back, Ben. Welcome.
Pleasure to be here. Thank you.
What's being said around the floor? Hats or no hats?
Hats, definitely. But funny little hats. You know, the Dow Jones is most important to the Main Street investor, not to professional traders. But it's great to have the buzz on the floor, to have the Main Street media. It's just another indication that the money flows back into equities. We were a second-class citizen for 4 years, and here we come. You had Warren Buffett yesterday with Miss Quick. Great hit, great way for the world to know that the equities are someplace you need to be.
We've had 8 good weeks of flows in our direction. And now the data here suggesting or confirming what Chicago PMI said, and that is that order cycles are beginning to fire up. How much does that mean to the long term?
Well, I mean, it adds the whole theme that the investors are looking at equities and the world economy as the glass half full. When the ISM numbers and all those numbers continue with readings above 50 and indicating they're going to get better, just another reason for the average investor to come back into the equity marketplace. You had a story out of TD Ameritrade today about flows and seeing the buying the dip mentality, adding to the positions in Facebook, etc. Those are all great psychological indicators that for the health of the equity market.
Does it matter that the S&P has not yet come back fully? Because we're crashing up against some important resistance here, and you cannot really say that the American stock market has fully recovered until you achieve that. And the temptation, the expectation would be that there would be some selling on that S&P at that level.
And the temptation has hurt people like me, the professionals who have been looking at this market, looking for that 5% pullback. Whether you listen to Mark Newton, who's been on your air with his technicals, or Tom DeMark, all suggesting that for the health of the market, you need to have that pullback. We haven't seen it. You're fighting this tide of inflows into the equity market that drive this market, and quite frankly, professionals are waiting for that pullback, but it's been a painful trade.
Conversely, if you break through it, presumably all the bells go off.
Correct. If you break above that resistance line, you can continue to go. But for the overall health of the market, for the average investor to be happy at the end of the year, you've had a 7.5% return in 2 months. That's a great annualized return, no less, in 2 months' time. You need to have that, whatever you want to call it, market maintenance. You need to have that pullback, to have that reset, and that's when the long-term investor, in my opinion, should be buying when stocks are going down, not going up.
So what are your clients doing at this point? Are they just holding their breath and getting in because you can't fight that? Or are they worried about the typical seasonality that does creep into those markets? And so, to your point, waiting for some sort of a pullback for the health of the market?
The professional portfolio managers have been putting money to work the inflows. However, some of that money, if they have the ability, have been buying protection. There was a good trade in the early part of February by buying the VIX. You had a great hedge on, and you had a pretty good return with the way the VIX increased. So if the problem is, if you're depending on the mandates of your funds, if the money's coming in, you have to put it to work in equities. That's why you're seeing this inflow. If you have the benefit of saying, wait a minute, every indication I have from my professional readings are saying I can probably buy stocks cheaper if I wait a little bit, that's what we're seeing.
All right, Ben, thanks for coming by. We
Pleasure.
appreciate it.
Thank you.
Ben Willis.